So, David, it's not a very easy task, but what sense was made out of this week?
Oh, this week was volatile. At least it ended on a happy note. Happy Friday the 13th. And we appreciate that equities ended the week on a strong note. But let's face it, the equity market and most asset classes have been under a lot of pressure year to date. The S&P, it's flirting with a bear market. It was down as much as 19% during the week. Now it's down 16% from its all-time highs.
Well, what about that bear market, Kate? Because some people, at least around Bloomberg, late on Friday, were saying what we really saw was a bounce off of that level of bear market, sort of a bear market bounce, as it were.
Yeah, I mean, the way I think about today's trading, David, was more that the sellers took off early for the weekend rather than buyers having a huge amount of conviction. You know, I think sentiment is such an important thing to track right now. And we're seeing kind of all of the major segments of investors, whether it's retail or traditional mutual funds and long only and hedge funds, have a pretty dour outlook for both the market and the economy. And, you know, it's my view that we're not going to see a meaningful and sustained rally, something that takes us closer to, say, 4,500 on the S&P, until we can really firm sentiment and kind of allay some of the fears around the economy and inflation and policy mistakes and the war in Ukraine and Chinese growth. I mean, the list goes on. You laid that out at the beginning of the show.
Well, it does make sense to me what Kate's saying. I think we're in a range-bound market for some time. Markets just need to figure out what the normal interest rates are. And until we have an understanding as to where interest rates stabilize, and especially not until the bond markets stop suffering losses, the equity market's at risk. I think the S&P is in a trading range that is not much lower from where we were this week, but 5,000 is likely out of reach for the next year, maybe two.
So, Kate, when you look at the equity market in relation to the bond market, how much of this is discounting future earnings? Basically, there's a discount rate put against future earnings. And how much was actually the multiple?
Yeah, I mean, look, in the highest growth parts of the market, the stuff that was commanding ridiculous multiples for a lot of 2021, you know, that de-rating really started in November and has continued through the course of 2022. Look, I think it's fair to assume that rates are going to have to move higher. You know, even if the economy is slowing a bit, we still believe we're far away from a recession, and we think the Fed is in the very early stages of normalizing policy, both in terms of policy rates, as well as, of course, quantitative tightening and reducing, changing the size of the balance sheet. So, you know, those two things together are going to, I think, exert a bit of pressure, and I think going to keep volatility high. We keep watching the relationship between, you know, rates vol and equity vol and see if there's a change in the pattern. But right now, I think they're going to stay elevated.
That's exactly right. I mean, we're watching interest rates. We're watching interest rate volatility. It's just representative of how much uncertainty there is on where interest rates are likely to go up, but where do they plateau? And yes, higher interest rates, particularly higher real interest rates, is reducing the PE multiple. And then there's this uncertainty about how long this expansion might last. I've said that this expansion is 2 years old, but perhaps going on 7 or 9 years old biologically when it has a 10-year expected lifespan. So they've not only used a higher discount rate to take in the PE, they've also shortened their forecast horizons, and so they're not paying for future growth. Instead, they're valuing the more certain earnings and dividends that you see coming from certain companies now.
Yeah, and I have to say, you know, we look around and say there are a lot of high-quality companies that you want to own for the next 3 or 5 years that are trading at pretty attractive multiples right now. That said, could the multiples overshoot to the downside? I mean, I think the answer is yes. There's a high probability that as the uncertainty rises around the macro environment and policy, that you end up seeing multiples get to kind of really silly cheap levels. If you want to average in, then great, but this is a challenging environment.
I think it's still a good environment for the long-term investor. You have to find that person. That person needs to really understand the volatility they may be facing. The S&P is trading at 17.5 to 18 times this year's earnings. A 20 PE is still reasonable given these interest rates. They're still much lower than history. Now, the Fed has an inflation fight to fight, but it's unlikely that interest rates go anywhere near where they were historically.
So, Kate, we've really focused quickly on inflation, which is only appropriate given the CPI numbers we had this week, and the interest rates. But there are other risks out there as well. We have a war pending in Ukraine, for example, and there are possible effects on the supply chain. They can affect certainly the cost to companies going forward in their margins.
Yeah, I think this is one of our big focuses right now. Look, when you look back a couple years ago during the trade war and some of the changes in terms of tariffs, for example, you had a lot of companies come out and say, hey, we're going to rejigger our supply chain. We're going to rethink, where we're producing relative to where we're selling. They said that. There wasn't a lot of follow through when it came to capital expenditure and investment in order to onshore or reshore some production. I think this experience of the last 2 years of the pandemic, and certainly the supply shocks that we've seen in part because of dependence on China, is going to incite a new round of capital expenditure, actually a real one, in terms of supply chains. But that's expensive, David, and it's going to cost companies a large amount of money and take time. So we got to watch margins.
It's a challenging global economy. The partnerships that we've had in Asia and the challenges that Europe is now facing for their security, for their energy, and even a refugee crisis. There are many threats out there to the health of this expansion. And the pandemic and some of the monetary and fiscal responses to it have caused demand to cause a bit more inflation than any of us are comfortable with in the past 40 years. But I'm also taking more concern with secular challenges, structural challenges, facing the global economy, because things that drive productivity, trade, global investment, demographics, cooperation on a global scale, these are things that we're not seeing as much of that we saw in past decades, and we even have more resource constraints. So inflation should come down, but it may not come down as fast or as low as the Fed wants it to come down.
Kate, we certainly have a risk on interest rates, although I think we're pretty clear that they're going to go up. It's a question of how far they go up and how fast, not whether they're going to go up. But if I had to make you choose between the biggest risk in terms of uncertainty and between, on the one hand, interest rates for an investor and the war in Ukraine and the uncertainty of that, which would you pick?
Oh, David, that's a tough question. I don't think that interest rates are that uncertain. In fact, I give Jay Powell and the Fed broadly an A+ in terms of how they've been communicating more recently. I think it's very, very, very clear to see that we'll continue to raise policy rates through the balance of this year, and that will be a steady progression. We'd have to have a massive shock, I think, in terms of, an economic shock or an expansion of the conflict that's currently in Ukraine. I am worried about the shifting of political alliances. I am worried about what this does to overall energy relationships. I am worried about the feed-through to European growth of this ongoing conflict in Ukraine, though.
Similar thoughts. We're more concerned about the war, the conflict in Europe. It speaks about the dare I say, deglobalization, just a lesser cooperation that's been in the world. Interest rates, the Fed is doing what they need to do. This looks like it will be a typical Fed hiking cycle of about 300 basis points and 3% of total Fed hikes over a 1.5-year period. A pretty normal Fed hiking cycle, even though inflation has jumped higher than we've seen it in so many decades. But the Fed may be facing challenges greater than normal owing to these global threats that we see out there.